All right, hey everyone. Thank you for joining us tonight. My name is Jonathan Zikorsky. I am the program manager of the Community Navigator Pilot Program at Universal Processing. And we have put together a little presentation here for you all today to learn some financial management, bookkeeping, and forecasting tools. So this program is brought to us by the Community Navigator Pilot Program, which was created by the SBA in an effort to connect socially disadvantaged small businesses to resources that will help them grow and improve. The SBA enlisted the help of 8 national hubs to aid marginalized small business owners, and the U.S. Pan-Asian American Chamber of Commerce, U.S. PAC, was selected. The U.S. PAC chose Universal Processing as a national spoke to promote the CNPP. Within the Asian American business community. As a spoke, we at Universal Processing are promoting the CNPP within our community and directly helping small business owners by providing free webinars on essential business education, free business consulting, help with loan and grant applications, and a lot more than that. So these are some of the topics that we'll be going over today. Our learning objectives are to be able to explain the concept of financial management and why it's important to all small businesses, to identify financial management practices, rules, and tools that are commonly available to small businesses, explain how these financial management practices, rules, and tools work, explain financial management basics for small businesses, explain the basics of startup financing, explain the basics of financing for a growing business, explain the basics of financing working capital, and explain the basics of financing fixed assets. So that sounds like quite a broad range of things. One thing this presentation will help you with is getting yourself and your business organized to be able to start a financing journey, whether it's looking into loans or grants. All of the things that we'll go over in this presentation will help you along that journey. So as we start this presentation, I think that something that would be helpful for everyone to think about and wrap their head around where they are in terms of the financial management of their small business and what that statement kind of means to them. So the first topic we'll cover today is budgeting. Creating a budget is the first place to start with your financial management practice. A budget is a list of all of your monthly or yearly expenses organized by categories. A budget is a tool that will help you to track your business expenses, plan for the future, economize when you need to, and plan for expansion. Another key area that we'll focus tonight is bookkeeping. Bookkeeping is the organized process of tracking all income and expense transactions. Bookkeeping is a critical component of financial management, which leads to better business decisions regarding financing, taxes, owner's draw, and retirement. So bookkeeping is a pretty broad topic. There are a lot of steps that go into the practice of bookkeeping. We'll take a look at the 10 basic bookkeeping steps. The 10 basic bookkeeping steps are to obtain business and accounting software. Proper software selection is critical for success. It's become very complicated and very difficult to try to manage your small business on pen and paper. I think those days are past, and we're very fortunate to have a lot of different solutions when it comes to accounting software that are really maybe a little bit difficult to get used to initially right off the bat, but these tools are going to make it much easier for us in the long run. Will make it much easier for us to be organized and have everything, all of the information that we need to have. We'll help open a separate business checking account. Do not mix businesses and personal checking accounts. A general theme that we'll see along this presentation will be the need to keep business and personal records separate. We'll reconcile checking accounts. Each month, it's essential to reconcile your account using business accounting software or a cloud computing reconciliation process. We'll track sales, create an airtight system for tracking sales using tools such as register tape, invoices, and a sales book. Always use this sales tracking system. And deposit all sales. Using the duplicating deposit slips, deposit all sales in your business checking account. Alternatively, remote deposit capture, or RDC, may be available for depositing checks. Total sales should equal total deposits. Do not spend cash sales. Link all forms of sales documentation such as invoices, cash register tapes, and sales books with a specific deposit. Number 6 is to write business checks for all business expenses or use a business check card. Do not use a petty cash system until you are experienced at bookkeeping. A petty cash system can be very difficult to track, and with these other systems, it'll keep our records much easier to understand. Obtain a separate business credit card. Do not mix personal and business expenses on one credit card. A theme like we mentioned before, to make sure that we keep our business expenses and our personal expenses separate. Pay business expenses first. Most businesses start out as a sole proprietorship. In sole proprietorships, you, the owner, do not get a salary, rather you take an owner's draw. A common question is how much draw to take. Here's a rule of thumb. Sales pays for business expenses first, personal expenses second. The owner's draw and addressing that first is something that we will come to a little bit later on, but it's very important. Running a profit and loss statement, another topic we'll cover a little bit later on. A checking account balance is not a good indication of how much profit the business has made or what amount is available for owner's draw. A P&L statement can provide a better picture of the financial health of the organization. To draw this back to the topic of financing, if that's something that you may be looking for your small business in the future, a P&L statement is a very essential part of that process. And then again, pay yourself with owner's draw. Owners should pay themselves by writing a check or making an electronic transfer from a business account to a personal account. If you are a sole proprietor, assign those draw checks to an equity account called draws. One way we can make this process of bookkeeping much simpler is by implementing some of the financial management tools that we have at our disposal nowadays. So a quick note is, if you're not already using it, start. Don't rely on paper to record your financials. There are many practical reasons to purchase and learn how to use off-the-shelf or financial management software. If you are unfamiliar with how to use it, take a course at a local community college or business development center. This is a great way to invest in your company. If there's anyone out there watching today that is interested in beginning or implementing a financial management software, reach out to us at cnpp@uprocessing.com. We're happy to consult with you and point you in the direction or connect you to an SBDC or a local community college where you can take a course and get started with the financial management software. Financial statements. Financial statements are reports about a business's financial health and cash flows. There are 3 basic statements: the balance sheet, cash flow projection, also sometimes called a cash flow statement, profit and loss statement, P&L, also called an income statement. We don't have enough time here tonight, unfortunately, to go through all of those super in depth, but we will explain them. And there's a lot of content in the participant guide, which I've shared to you via the chat, and we'll be making references to that throughout the presentation. So if you haven't yet, go ahead and click that. There's a lot of good information in there. So balance sheets, please turn to pages 10 to 13 in your guide. I'll provide a high-level overview only. There is more detail to read over on your own time. A balance sheet is a snapshot of a business at a specific point in time, such as the first day a business opens its doors. Subsequent balance sheets are prepared at the conclusions of accounting periods such as monthly, quarterly, or year-end. A balance sheet reports the dollar value of a company's assets, liabilities, and owner's equity as of a specific date. Assets include cash, accounts receivable, inventory, investments, land, buildings, equipment, and some intangible items and other assets. Liabilities are the debt of the or obligations of a company and include loans payable, accounts payable, taxes payable, and more. The owner's equity shows the amount of assets that came from the owner and not creditors. These two points are very important for small business owners to understand. Assets and liabilities, of course, everything that the business has in the positive column and everything that the business has in the negative column. Again, as we're cleaning up our financial statements and maybe looking down the road of projections or financing, understanding what your company has as far as assets and liabilities it's very important. And lastly, the balance sheet tells a story about the assets your company controls, such as cash, equipment, and inventory. The balance sheet explains who owns these assets, someone else, creditors, or you, owner's equity, how much working capital cash you have to run your business, and if the company is highly leveraged or carrying too much debt. So constantly that plus and minus, where do you stand in terms of the assets that you have versus your liabilities? So one of the major points is, of course, creating all of these documents is what story do they tell? As we go through this, this cash flow sheet, we're going to try to learn how to decipher the story that it's telling. And as small business owners, what story do we want it to tell? What story do our financial projections tell about our business? So cash flow. As with the balance sheet, we will quickly review the information in your participant guide about cash flow. Cash flow can be defined two ways: balance of cash received less the amount of cash paid out over a period of time, moving cash in or out of a business. For more detailed information about cash flow management, sign up for the MSSB class, Cash Flow Management, which goes into this topic in greater detail. For the folks that are interested in that class, please reach out to us at CNPP at uProcessing, and we can connect you with that information. So cash flow projections. What is a cash flow projection? A cash flow projection is a financial statement that tries to show how cash is expected to flow in and out of a business over a future period of time. A cash flow projection is used to see if projected cash receipts inflows will be sufficient to cover projected cash disbursements or outflows. A business can be profitable and still run out of cash. As an investment banker might say, cash flow projections provide the visibility needed to avoid liquidity problems. In other words, a cash flow projection is a tool to help you manage your cash so you can pay your bills on a timely basis and keep the doors of your business open. Cash flow projection is incredibly important. We need to be keeping track of all of the avenues for which cash can be coming into our business, and of course, all of the ways that cash can be coming out of our business.
That will help us plan for the future and not let expenses and outflows sneak up on us as much as we can. How can a cash flow projection help, and when do I need one? A A cash flow projection is a great tool for setting sales goals and for planning for expenses to support those sales. A related use for a projection is to determine your break-even point during a startup or expansion phase. If you need to plan for a large expenditure such as an equipment purchase or move to a new location, a cash flow projection is the perfect tool. Similarly, if you have a seasonal business with large inventory purchases, a projection can help you have the cash on hand to make a large inventory investment when you need it. A cash flow projection is another tool that is critical in looking for financing. For a loan, the bank may ask you, how do you plan on using this? And then you can show them your cash flow projection and look, we expect these costs in the future, and these are what we would like to use the financing for. So we've touched on this. To track liquidity when accrual accounting makes cash realties. Helps you determine your need for financing and shows lenders your ability to pay and repay financing. So this is a cash flow projection sample. Let's look at it and we'll see that the first set of rows titled sources of cash document all sources of incoming cash, including cash from customer sales, interest earned, loan funds, and current checking and savings account balances. The second section, operating uses of cash, contains all those expenditures associated with the day-to-day buying and selling process. Most of these expenses show up on the P&L statement. The third section, non-operating use of cash, show expenses that normally show up on your balance sheet. Equipment purchases, the principal portion of loan payments, inventory, taxes, and owner's draw. Subtract your use of cash from your total cash available, and you have ending cash for the month. Ending cash for the month becomes opening cash for the next month.
So what could the owner do in a situation where they need to increase cash flow? Increase the number of items sold. They could increase prices, reduce expenses, change the timing of expenses, save money to have sufficient operating cash to get through the startup period, obtain sources of cash other than sales, such as a line of credit, reduce or change the timing of your owner's draw, research vendor options for buying inventory at a lower price, or obtaining credit from vendors. Establish policies to get paid sooner from customers. So a lot of these tactics are not necessarily meant to get out of certain cash flows out, but to redirect the timing of them so as that they come up when the business may have a greater inflow of cash, sales may be up, expenses may be down. As we know, the small business world is never constant. There are ebbs and flows, and there are things that we can do with our cash flow to help out our low times by all of these tactics we just went over. Another really important tool for small businesses is the profit and loss statement. The profit and loss statement, or many times you'll hear it referred to as the P&L or income statement, is the best tool for knowing if your business is profitable. A P&L statement measures revenue, also called sales or income, and expenses over a month, quarter, or year. With it, you know if you have made a profit and how much, or if you've incurred a loss. The most important financial management report is the P&L statement. A P&L statement will reflect your business decisions on the basic buying and selling process. A P&L will tell you how well you're managing your business and provide information on how to grow your business. So the basic formula for a profit and loss statement is positive sales over the cost of goods sold is gross profit over overhead is net profit. So let's actually go back to that. So sales, also called income or revenue, total amount from selling your product or service during a certain time period. Over the cost of goods sold, the total expenditure for inventory items which customers buy. Cost of goods sold consists of the cost of purchasing the items, freight, manufacturing costs, modification costs, and packaging. For services, this is the cost of providing the service, including labor, materials used, and transportation. And then the gross profit is sales minus the cost of goods sold or services provided. Overhead are expenses associated with your ongoing business and operation, and net profit is gross profit minus your overhead. So what is the best formula for a profit and loss statement? Net profit pays for owner's draw, the money you take home, future expansion in equipment, so reinvestment in your business, principal loan repayment, and income taxes. How do I compile a profit and loss statement? You might be asking yourself. Well, it's easy if you have business accounting software. Review the sample profit and loss statement in the participant guide. What do you see? Is the business well managed? Do any problems stand out? What about growth potential? Will the business support the owner? Will the business be able to get a loan? Does the P&L paint a profitable picture of the company? Is the owner going to have a draw? Is the owner going to be able to take money out? These are all questions that we can answer with the profit and loss statement. And the profit and loan statement will help us dramatically in assessing business financing. What is business financing? The following items are core elements in business financing. Equity financing, which is invested funds that stay in the business, often permanently. For most small businesses, equity comes from the owner or from family savings and is frequently the only source of funds for a startup, small businesses. For large, fast-growing quality companies, venture capital can sometimes be accessed for equity. Debt financing. Let's move on to the next slide here. Skipped ahead too early there. There's debt financing, which are borrowed funds that are paid back. The cost of debt financing is interest paid to the lender. Working capital, used to acquire funds needed to run the daily operations of the business, such as inventory and overhead expenses. And then fixed asset financing, used for purchasing equipment, vehicles, and real estate. So often when we're considering getting access to financing in the form of loans, they'll often ask us, what are you using these funds for? And are they fixed assets? Is it for purchasing equipment, vehicle, real estates? These are all questions that we need to have answered when we're addressing going out and looking for financing. So what are the do's and don'ts for small business financing? Invest your own money. You need to invest your own money first. Before you ask for equity or debt from other sources, having your skin in the game shows your commitment to and also shows your skill in running a successful business. Earn the right to borrow. Generally, borrowing is not a right. Rather, the ability to borrow is an earned privilege. To obtain others' investment, you need to demonstrate your ability to manage debt well and run a profitable business. Show profitability. Profits are what lenders or investors want to see. Do not let lax management inhibit a healthy bottom line. Understand and retain working capital. Experienced business owners know that working capital is crucial. On the other hand, working capital is sometimes overlooked or misunderstood by new business owners. As your business grows, the amount of working capital cycling through the business to support operations should grow. Successful business owners stay aware of the working capital needed to grow and sustain their businesses. Be lean on fixed assets. New business owners sometimes think they need to purchase fixed assets to start or grow a business. Fixed assets consume precious working capital through down payments and monthly loan payments. So whenever possible, new business owners should buy as few fixed assets as possible When acquiring fixed assets, new business owners should consider buying used assets or leasing the assets. Match sources and use of funds. When financing current assets, accounts receivables, and inventory should be financed with current liabilities, line of credit or credit card. Fixed assets should be financed with long-term loans that match the use of the asset. New business owners can make the mistake of buying a fixed asset with short-term debt, forcing them to pay for an asset faster than that asset can generate profits for the loan repayment. That's really a really important point, is to understand how quickly an investment in your own business will pay for itself, essentially. Are you going to incur more costs more quickly than that investment is going to be able to generate an inflow of funds for you? And of course, understand your financial statements. Most types of financing require an application process that asks for business financial statements such as your P&L statement, balance sheet, and a cash flow statement. It's essential to understand risks and costs for loan types. Each type of loan carries associated risks and costs. For example, while a credit card may be easy to use, credit card financing may be a very expensive form of credit. In many cases, a small business loan guaranteed by the SBA will be a better form of loan than a credit card. If anyone out there has any questions on the types of loans, especially those that are available through the SBA, please don't hesitate to reach out to us at CNPP at uprocessing.com. We're happy to hop on the phone with you or have a consultation and help walk you through the different kinds of loans that are available. And then shop around. There's a common mistake, shop around for the best loan. You may want to start where you already have a personal relationship. For example, if you have a personal account at a bank, start there. Check out SBA loan guarantees available at most commercial banks and get expert advice. You can get mentoring and advice with the SBA. You can get mentoring and advice with CNPP team at uProcessing or any of the other spokes. And do not rule out banks, especially ones with which you have a good working relationship. The FDIC has educational resources as well. Loans. Steps for getting ready for a loan. A lot of the documents that we've covered thus far are very critical in applying for a loan. Have a business plan. We haven't gone over business plans in this module specifically, but having a business plan that details a statement of purpose, lists out the business owners, and describes what the business will use the funds for is incredibly important. It's important to also know what you can afford. Using the likely loan terms, calculate the amount of funds you'll need and the monthly loan payment. Study your financial statements. As mentioned earlier, a lender will want to see your financial statements. Not only do you need to provide accurate, current, and historical statements, you need to know what your statements say about your business. Be prepared to discuss the details of your statements and explain any issues. You need to understand your statements and be able to tell the story that they represent, especially when you're going and looking for a loan. It's really important to understand your financial statements and know what story they tell to a potential lender. Check your credit report, know where you stand, make sure it's up to date, accurate, fix any inaccuracies, and be prepared to explain any credit issues. Also, establish collateral options. Be prepared to discuss collateral with lenders. When you're purchasing a fixed asset, the asset is often the collateral for the loan. Lines of credit are sometimes unsecured if a business owner can show a strong history of profitability. But it is not uncommon to use personal assets to collateralize a business loan. Show your equity contribution. So this is something we touched on earlier. Show that you have skin in the game. Show that you first are invested in your own business before you ask someone else to be invested in your business. And research your financing options. Become an educated consumer. There are so many different financing options, and they will land you in so many different situations. It's really important to think about what you're comfortable paying, the term you're comfortable paying. And if these are daunting challenges, then reach out to resources that are happy to walk through the process with you. We'll talk a little bit about the common elements of a loan package. We've touched on many of these already. Having a business plan. Lenders will require a business plan that describes your costs and your management and sales strategies. Business financial statements, we've talked about that quite a few times. Personal financial statements. A personal financial statement shows your personal assets, liabilities, and net worth. And personal and business tax returns. Lenders often ask for up to 3 years of past tax returns, both business and personal. What are the elements of a loan package? Source and amount of equity contribution. Business loans usually require the business owner to contribute between 10% and 30% of total project costs in cash or equity. Include a write-up documenting the amount and source of your equity contribution. Credit report. Lenders will order your credit report, but it is important that they will see in the report. Make sure you have addressed any credit issues that are contained in the report. So the credit report is it's important that it's part of the toolkit that shows that when you go to look for financing, you're well prepared, and you know that your lender is going to take a look at your credit report. So you don't want to be in a meeting and say, oh, I didn't know about that, or I didn't know that was on there. So it's important to have a look at that and understand the story that piece of information is telling too before you set out and look for financing. And then collateral. Lenders usually require collateral. Include options for collateral in your application. And purchase agreements, appraisals, contracts, and estimates. Include purchase agreements, appraisals, contracts, and official estimates to document costs that pertain to your project. So show a little bit more of a plan and the research that you've done beforehand of what you intend to use potential funds for. Qualifying for a loan. Good credit score will help you. Nothing shocking about that. Equity contribution. Sufficient equity contribution shows a lender that you have a commitment to the project and the ability to earn, save, and manage money. Equity contribution really shows good faith and your belief that you are confident in investing your own money in your business. And then repayment ability. Lenders often analyze financial statements from the past 3 years to see if the business has the historical ability to pay debt service. Lender criteria vary, however. You will probably need to show that you have strong profits, good cash management skills, and growth potential. So those good cash management skills, hopefully some of these financial documents, bookkeeping, the P&L statements will help with that. The need to show historic evidence is why it is harder for a startup business to obtain a loan. On the other hand, while most loan applications require projections, it is more difficult to qualify for a loan on projections alone. So it's really important to show history. And then a loan to value ratio. Lenders tend to loan between 70 and 90% of the market value of an asset. If you are buying real estate, an appraisal will be used to determine the maximum loan amount. And then moving on a little bit, startup financing. There are some different options for financing a startup business. Um, the first is equity. Equity is simply, it is your money. Many businesses are started with savings from a day job or through the sale of an asset. You can launch your business by starting small and reinvesting the profits over time to build up the business. Sweat equity. Sweat equity means doing it yourself. Owners of startup businesses are often a jack of all trades. You put in the hours to cover the many activities of your business rather than hiring others or buying equipment. I think every one of the small business owners that I have interacted with certainly understands sweat equity. And there's credit cards, business credit cards. Owners of startup businesses can often qualify for a credit card. When used wisely, a credit card can be a source of credit for starting a small business. And we have some tips for using credit wisely. Get a separate credit card for your business use. We've mentioned that a few times. Always, always, always important to keep personal and business expenses separate. Use only one credit card, not multiple cards. Keep your balances modest. Pay the balance before the due date to avoid paying interest. And do not use a credit card to prop up an unprofitable. And also family. For those that have that opportunity, there are some business owners that turn to their families for an equity contribution. If you're looking for a business loan, there are a few places to turn. Banks, unsurprisingly, especially those that have SBA guaranteed loans. Again, if you are interested in anything along those lines, don't hesitate to reach out. There are also regional lending organizations. Many are nonprofit. There are community development organizations that have revolving loan programs. A lot of these will offer lower rates. So those are a great resource to look into. And key points to remember, financing is getting the money you need to start, operate, or grow your business. Start with a budget. Sound bookkeeping is the basis for all financial management. Purchase financial management software and learn how to use it. I know that can be quite a hurdle for some folks, but it is worth the investment in your time, and it will help make this process much easier. And the three statements: balance sheets, cash flow statements, and profit and loss statements. They provide a compelling story to describe a business. Can't really add too much to that. They're storytellers, and they're absolutely paramount. And of course, separate those personal and business records and funds, and factors that affect your ability to get a loan: credit score, equity contribution, repayment ability, and loan to value ratio. All right, so we're coming to the end here. In summary, we've covered a lot of information. Does anyone have any questions? All right. Well, I think I hope that was helpful. I hope that we've answered some questions in how to paint a complete picture of your business with these three financial documents. Also showed some of the tools and tips when seeking financing. And I appreciate everyone taking the time to tune in to us this afternoon. And if there's any questions that you have in any of the topics related to this, please don't hesitate to reach out to CNPP at uProcessing. we are eager to help out. Thanks again, everyone, and thanks for joining us.